If you're here, that means you likely want to learn more about charitable trusts. Hi, I'm Chuck Roulette. I'm an estate and elder law attorney licensed to practice in both Florida and Minnesota. And today we're going to talk about a powerful tool that can help you support causes you care about while also benefiting you and your family. It's called a Charitable Remainder Trust, or a CRT for short. But before we get started, if you haven't already, make sure to hit the like and subscribe buttons. It's free and you'll be notified when I post new videos like this one. And if you have a question, post it below and I may answer it in an upcoming video. So what exactly is a charitable remainder trust? Well, think of it as a way of having your cake and eating it too. Here's how it works. You set up the trust and you transfer some of your assets into it. Once that's done, the trust pays you or your chosen beneficiaries an income stream for a set period of time. When that period of time ends, whatever's left in the trust can go to your chosen charity or charities. It's a win-win situation. You get income and tax benefits, and your favorite charity or charities get a significant gift down the road. Now, there are two main types of charitable trusts: charitable remainder annuity trusts, or CRATs, and charitable remainder unit trusts, or CRUTs. So with a charitable remainder annuity trust, a CRAT, you receive a fixed dollar amount each year. It's simple and it's predictable. So for example, if you set up a CRAT with $1 million and you choose to receive 5% annually, you'll get $50,000 each year, regardless of how the trust's investments perform. A charitable remainder unit trust, or CRUT, on the other hand, pays you a fixed percentage of the trust value each year. This means your income can go up or down as the trust value changes. So if we use our same example, we put $1 million in a CRUT and the trust grows to $1.2 million the next year, your 5% payout would increase to $60,000. Now, why would you want to use a charitable remainder trust? Well, there are several compelling reasons. First, you get to support causes you care about. Second, you can receive income for life for a set period of time from the charitable trust. Third, you get a tax deduction now for the benefit of the assets you put into the charitable trust. Fourth, you can avoid capital gains tax on appreciated assets. And finally, fifth, you reduce your estate tax burden. So let's look at an example to see how this might work. So in our example, again, we're not saying this is exactly how the numbers would work out. When we're setting up charitable trusts, we can actually do modeling with you to show how it might work. So just for illustration purposes, let's assume John and Sarah are both 65 years old. They're retiring and they're selling their business, which is worth $10 million. So instead of facing a huge capital gains tax bill if they were to just sell the business outright, they set up a CRUT. So here's what happens. They transfer the business to the CRUT. The CRUT then sells the business for $10 million, paying no capital gains tax. John and Sarah choose a 5% payout. That gives them $500,000 in income the first year. They also get an immediate tax deduction of about $5 million. Then after 20 years, assuming 7% growth, the trust will have paid them about $14 million in income. And then at the end of their lives, their chosen charities will receive over $20 million. So as you can see, a charitable remainder trust can be a powerful tool for generous families, but it's not right for everyone. You should consider a charitable remainder trust if you have highly appreciated assets you're considering selling, such as stock, a business, or real estate. And one asset that works really well in charitable remainder trusts is qualified retirement accounts, such as IRAs. So a number of clients we're working with have large IRAs, and they're thinking about putting them into charitable remainder trusts. You're charitably inclined. You want or need income from your assets. You're comfortable with irrevocable gifts, and you have a substantial estate that might be subject to estate taxes. Now, having said all that, there's a lot more to know about charitable remainder trusts. They're complex tools that require careful planning and professional guidance. And if you're intrigued by the potential of a charitable remainder trust, here are some steps to consider. First, reflect on your financial goals and your charitable intentions. 2, take stock of your appreciated assets. 3rd, think about your current and future income needs. 4th, consider charities that you'd like to support significantly. And 5, most importantly, consult with an experienced estate planning attorney who understands charitable trusts. At our firm, we specialize in helping families like yours create estate plans that reflect your values and achieve your goals. And we'd be happy to explore whether a charitable remainder trust might be a good fit for you. Again, with the right planning, you can create a legacy that makes a real difference. Now, if you'd like to learn more or schedule a consultation, you can visit us at roulettelaw.com. I'm also going to be hosting a free online masterclass where I reveal strategies I use with my private clients to make it as easy and inexpensive as possible for their families to manage their affairs if anything were to happen to them. In the class, I'm going to be discussing how to avoid probate, wills versus trusts, and how to decide which is the right fit for you, how to minimize or even avoid estate taxes, how to protect the money you leave for your kids in the event they get divorced, get sued, and much more. Again, it's free and you can sign up by clicking a link in the description below. I hope you found this video helpful, and I look forward to seeing you in either the masterclass or an upcoming video. Be well.